We're growth managers. Hopefully you're all pretty familiar with what Hyperion does. Just on a very, very quick recap, we're trying to grow our clients' capital sustainably over the long term by investing in businesses that have superior long-term economics. Missions and value statements are up the top there. You know, the real key ones are we are absolutely alpha focused. We are inherently aware that Hyperion does not deserve to exist if we can't produce alpha over the long term for our investors. We're long-term thinkers with everything that we do, how we invest, how we set up our company, and we're generalists who place the collective first. The collective are our investors, who are ultimately your clients. Our returns, you can see up there on the right-hand side of the chart. Net flow from clients only really makes up 15% of the money that we run. 50% comes from market returns, and a third of the money that we actually have in our three portfolios of the 14 billion comes from the alpha that we've been able to generate. We're very proud of the return profile that we have. It's been, as Mark said, over 25 years in the strategies that we run. We're very clear about the inefficiencies that we exploit. A number of you were here last year where you would have heard me talk about the time arbitrage that we deploy and also the quality anomaly, but we're also very clear about when we would expect to outperform and also when we'd expect to underperform. So on the right, you can see when we'd expect to underperform. Funnily enough, bond yields rising very sharply, very rapidly in a short space of time. We are a longer duration style of a portfolio, so that doesn't work well for us or pretty much any other asset class, as we found out during 22, as we've been reminded. Also, when you have market rotation events during that time, or where economic growth is actually at high levels, when you have high nominal GDP growth, you don't need to worry about cash flows and earnings that are coming in years 5, 7, and 10 years. You can go and invest in a services company and get paid with big chunky dividends right here, right now, today. But that's a one-off occurrence, and that only happens really once with dividend payments. But if you want to compound returns over the long periods of time, we'd expect to outperform when bond yields are stable and declining, and when you have low and slowing growth economic environments. The companies we invest in generally grow by taking market share, and if they can grow by taking market share, they should be able to outperform in most market environments. Again, you're probably familiar with this. What we're really looking for are new world companies. These are companies that are innovating, being disruptive, growing by taking market share. They're innovative. They're capital light. We don't like debt. There's only really 2 companies in the global fund that have net debt, and they're doing that for operational purposes. They're founder-led. You might hear a little bit more about that today from Solaris. And they have very large addressable markets. They are truly global businesses. Conversely, what are we trying to avoid? Old world, low growth businesses, your banks, your miners, your constructions, your traditional manufacturers. They're very reliant on economic growth. So if growth is slowing, they'll probably slow. We're also avoiding fads, concepts, startups, momentum style businesses. Now, we've had a phenomenal amount of returns over the last 18 months to 2 years across all 3 of our portfolios. And outside of the company's ability just to have larger earnings per share growth than our peers, there's 4 momentum drivers that we've effectively identified that are in play where we are today. The first one is pretty easy for us to explain. That's mean reversions of valuations. And so you can see here in the shaded area is the internal rate of return of our global product forecasted over 10 years. Now, historically, in the dotted red line, it's run at around 17% per annum, and that's effectively what we've returned for investors. It's currently sitting at around 20 to 21% per annum. So that means if we are correct in our assumptions and the companies do what we think they should do, the return profile should be, all things being equal, around that 20 to 21%. Historically, we've been pretty accurate. And you can see the performance in the solid red line of our global product versus that of the benchmark. And so with where prices are today, we'd expect to see valuations to come back towards that 17%. So prices going up, IRR coming down. The second of which is almost a derivative of the first part, is earnings leverage that we've seen within our portfolio over the last few years. The easiest way to talk about that is employee numbers, but we've also seen a lot of cost out initiatives for the companies that we invest in. You can see the solid red line from 22 has been going down quite steeply and dramatically to where we are to the first quarter of this year. And that's really the overhang of the large amount of employees that were sitting in corporations as we came out of the pandemic. But the result of that and other cost out initiatives is the earnings per share growth of our portfolio, which has really accelerated through into the back end of last year, and it's still at a healthy range. So the solid blue lines is the earnings per share growth of the portfolio, starting at just under 20%, and really driving really hard up to December quarter of 23, where we had EPS growth of over 80% in the portfolio. Now you can balance that out by looking at the median level, which is the red dots in between those, because to be fair, there are a few outliers of companies roaring back into profitability, like Amazon and Palantir and Spotify, etc. But even where we are in the first quarter, and we'll have more data in the next couple of weeks, what the second quarter looks like, we're seeing elevated earnings per share growth across our portfolio. We'd expect to see that to continue over the course of this year into next. The third part, and you've probably heard this, but you're going to hear it for the next decade, is artificial intelligence and machine learning. This is real. We think it's going to have almost the same effect as the adoption of the internet. But at the moment, we're only really seeing one or two legs of it. And the first part is the easy one to understand. That's the selling of hardware into the hyperscalers, which are the cloud computer guys. We own ASML. We think it's effectively a monopoly in what they do. We don't own NVIDIA, high quality company. There's a bucket load of competition coming for NVIDIA. They're probably over-earning by a factor of 3 or 4, but we'll own ASML. The next 3 phases are the things that are going to give you the reoccurring revenue, which we're really excited about. So the 3 cloud service provider, Amazon, Microsoft, and Alphabet, are seeing that already today. And then you step into the incremental software tiers. And that's where you'll start seeing the likes of Microsoft's Copilot. There's over 400 million monthly active users of 365. You don't need every single one of those to spend $30 a month on that new product for it to have a profound impact. But you'll also see that with ServiceNow, Salesforce, and Palantir. What we're really happy about in this space is that all of these software providers are already embedded in most businesses around the world. So when they provide this new software to their customer base, there's 0 cost of acquisition. And so you're further solidifying just the strength of the value proposition of your product to your customer base. And then the fourth part of AI and machine learning is when the processes come out of the cloud into the devices effectively in our hands, whether it's your phone, your laptop, your tablet, your car with Tesla with full self-driving, which is looking phenomenal. Block with their point of sale, Meta with the goggles, and ASML providing these high-powered chips to those businesses. And so the fourth part that we've started to see is a more stable macroeconomic environment as well. It's no surprise that in 22 we had a very high inverse correlation to interest rates, which is in the shaded area, 10-year US bond yields going up. The value of our portfolio, most duration assets came down, but that really has broken away. There's no longer that correlation. When we've been in a fairly stable environment effectively since January 23 all the way to where we are today, where US 10-year bond yields have been range bound around 400 to 450 basis points. And what we've seen from there is the earnings per share growth of our portfolio has really stepped in, and it's the big driver of returns. And that's the thing that's going to compound into the future. It's not interest rates going up or down. The absolute level of rates isn't really important. It's the velocity of where they turn, because you'll get a one-off movement in valuations, and then the compounding effect of the underlying earnings steps in and pushes your values further. So we have these 4 momentum drivers that are not mutually exclusive. They're happening at different parts of the portfolio at different times, whether it's mean reversion, earnings leverage, the advantages of AI and ML, and that stable economic environment, really driving these companies forward to new highs. But as always with Hyperion, we're always looking at the long-term signals that come from our portfolio. We have 12 long-term thematics that effectively diversify how we think about our universe. Hopefully this slide isn't new to you. But even though we run a concentrated portfolio of 22 companies, when we look at it and break it down by business segments on the EBITDA lines, there's 52 individual business segments within the companies that we own. So we're very happy with the diversification from a top-down level, from even being a very strong bottom-up investor. This is Hyperion really in a big chart, and I know this is blinking at me to hurry up. The earnings per share growth of our portfolio is run at around 21% per annum over the last 10 years, and we do have a 10-year track record in the fund now. If you remember back to those other slides, we're running at close to 40% EPS growth currently. We look at that versus our benchmark, which is run at around 9% per annum over that same 10 years. The businesses that we own, we actually see them, accelerating, taking market share, being more dominant, and earnings per share growth is growing even modestly, up at 22% per annum forecast over the next 10 years. And the reason we continue to talk about the earnings per share growth and why it's so important, you can see on this chart here, this is the return profile of our fund versus our benchmark. So we produced that 21% EPS growth over that year. We've had a small amount of dividend return and multiple contraction versus that of the benchmark of around that 9% EPS growth and multiple expansion. Your returns don't come from PEs going up or down or dividends over the long term. They're one-off factors. It really is that earnings per share growth. So if you're basing your investment philosophies or decision makings on dividends, on short-term PEs, you're probably just speculating. And I'd argue to you that to be able to produce long-term returns, you need to be investing in some of the best businesses of the world. They're never cheap. There's a reason why the Apples, the Microsofts, the Alphabets, the Amazons, the Teslas, the Salesforce, the Spotifys of the world are expensive. They have the growth. And you can even relay that back into the domestic market, whether it's CSL, Cochlear, realestate.com, WiseTech and Xero. They always trade at high multiples, but again, the economics have to stack up, and that's the one thing we spend a lot of time on. We're very proud of the long-term return profile of all three of our products. All three have alpha since inception and across most time periods. Always like to leave you with a quote, and to be an investor, you must believe in a better tomorrow. And at Hyperion, tomorrow looks awesome. Thank you.